Fractional investing is transforming how people build wealth by making high-value assets like real estate, fine art, and collectibles accessible to everyday investors. Instead of needing thousands or even millions to buy these assets outright, individuals can now invest with just a few dollars and own a fraction of the value. Powered by fintech and blockchain technology, this innovative model is democratizing investing, opening doors to diversified portfolios once reserved for the wealthy. We explore how fractional investing works, the asset classes involved, and what the future holds for this rapidly growing trend. Today we will talk about the rise of fractional investing, real estate, art, and beyond. So before we start, make sure to hit the like button and subscribe to my channel. 1. Understanding the concept of fractional investing. Fractional investing is revolutionizing the way people build wealth, offering a groundbreaking solution to the problem of accessibility in high-value asset markets. Traditionally, investments like real estate, fine art, and collectibles were exclusive to wealthy individuals or institutions due to the significant capital required. Fractional investing, however, allows individuals to own a percentage, or fraction, of these high-value assets, much like owning shares in a company. Through this method, investors pool funds to collectively purchase an asset and share in its profits, whether from rental income, appreciation, or eventual resale. Enabled by fintech platforms and blockchain technology, fractional investing democratizes access to once elite asset classes. This shift is empowering average investors to diversify their portfolios with tangible, appreciating assets that historically outperformed equities over time. 2. How fractional investing works across asset classes. At its core, fractional investing functions by dividing an asset into shares that are then sold to multiple investors. These shares are typically issued and managed through digital platforms that handle administration, legal structuring, and profit distribution. In real estate, for example, a property valued at $1 million might be split into 1,000 shares at $1,000 each, allowing investors to participate in real estate income without owning the entire property. In the art world, a $10 million piece by a famous artist might be divided into 10,000 shares, making it possible for someone with just $1,000 to invest. Platforms may offer returns through rental income, dividends, appreciation, or royalties, depending on the asset type. Investors often benefit from liquidity through secondary marketplaces, where they can buy and sell shares with other investors, although this varies widely based on regulatory structures and platform capabilities. 3. Real estate, the forefront of fractional ownership. Among all asset classes, real estate has seen the most widespread adoption of fractional investing. Residential and commercial properties alike are being offered to investors on platforms like Fundrise, RealtyMogul, and Arrived Homes. This model appeals to individuals who want the benefits of property ownership, such as cash flow, tax advantages, and appreciation, without the burden of managing tenants or financing entire properties. Investors can choose from different real estate sectors, including multifamily housing, office space, retail, or vacation rentals, tailoring their portfolio to match personal risk profiles and return expectations. The added bonus is geographic diversification. Someone in New York can invest in a booming Austin rental market without ever stepping foot in Texas. This flexibility, combined with low minimum investments, sometimes as low as $10, makes fractional real estate a powerful tool for income generation and capital growth, even for novice investors. 4. Art and collectibles. From paintings to NFTs, fractional investing has also exploded into the world of fine art and collectibles, where masterpieces and rare items have historically been out of reach. Companies like Masterworks and Yield Street are leading the charge, allowing users to invest in iconic artworks from artists like Banksy, Basquiat, or Picasso. These platforms typically acquire high-value art, securitize it through SEC filings, and offer shares to investors. Over time, investors benefit from the appreciation of these works, which are eventually sold, with profits distributed accordingly. Beyond traditional art, fractionalization is transforming collectibles. Think rare sneakers, vintage wine, comic books, luxury watches, and even NFTs, non-fungible tokens. Platforms like Otis and Rowdy let users invest in unique items with cultural or historic significance. For many, this not only provides an investment opportunity, but also a chance to engage in markets aligned with their passions or hobbies. However, these assets are generally illiquid and speculative, requiring careful consideration. 5. Technology and blockchain's role in fractionalization. The rise of fractional investing wouldn't be possible without technological advancements, particularly in blockchain and smart contracts. Blockchain provides a decentralized, transparent, and secure way to tokenize ownership, allowing for digital representation of real-world assets. This innovation is essential in creating trust and immutability in asset ownership records, especially when many stakeholders are involved. Tokenization breaks assets into digital tokens, each representing a fraction of ownership. These tokens can be stored in digital wallets and traded on secondary markets, or blockchain-based exchanges, depending on the platform's infrastructure and regulatory approval. Smart contracts further streamline the process by automating dividend payouts, compliance checks, and profit distribution, reducing administrative overhead and eliminating intermediaries. 6. Risks, regulations, and investor considerations. Despite its many advantages, fractional investing is not without risk. One major concern is liquidity. Many fractional shares, particularly in real estate or art, are not as easily tradable as stocks, meaning investors may have to hold them for years before realizing a return. Market fluctuations can also impact asset values, especially in speculative areas like NFTs or collectibles. Moreover, legal and regulatory complexities vary across jurisdictions. In the United States, the SEC treats many fractional investments as securities, requiring platforms to comply with strict disclosure and reporting rules. Investors must read offering circulars, understand fee structures, and assess the platform's credibility. There's also the question of control. Investors usually have no say in how the asset is managed or when it's sold. As with all investments, diversification is key. No matter how exciting the asset, putting all your capital into one fractional share can lead to concentrated risk. 7. The democratization of wealth building. One of the most transformative aspects of fractional investing is its potential to democratize wealth building across socioeconomic groups. Traditionally, the best-performing assets, such as prime real estate or blue-chip art, were only accessible to the ultra-wealthy. Fractional investing lowers the barrier to entry, letting everyday people participate in markets previously considered untouchable. It also offers educational opportunities. New investors can learn by doing, experimenting with different asset classes in small amounts. This shift has important implications for financial equity, as more people gain access to long-term, inflation-resistant assets. Millennials and Gen Z, in particular, are drawn to fractional models because they align with their digital native habits and financial realities. With high student debt and lower homeownership rates than previous generations, these cohorts are using fractional investing to bypass traditional wealth-building constraints. 8. The future of fractional investing. As technology continues to evolve and regulations become more accommodating, the future of fractional investing looks exceptionally promising. We're already seeing tokenized assets move beyond real estate and art into areas like sports franchises, private equity, farmland, and even music royalties. Platforms are becoming more sophisticated, integrating AI for better asset selection, improving user experience, and offering enhanced analytics for investors. Institutional interest is also growing, with major financial firms exploring partnerships or launching their own fractional offerings. In the coming years, it's likely that fractional investing will become as common as stock trading, with traditional brokerages and fintech platforms offering bundled services across asset types. However, responsible growth will require a balance between innovation and regulation. Investor education, robust due diligence, and platform transparency must remain top priorities. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.